Guys, and welcome back to another episode of Attempting to Turn 10k to 100k over time. So nothing special today. I just wanted to share my thoughts about an article I chanced upon, I think maybe 1-2 days ago. So this article is about Paul Tudor Jones. So if you don't know who he is, he's a legend on Wall Street, right? One of the goated hedge fund managers. His style in particular is trading, and I think he's one of the best in his game for trading, right? So the article said that or rather the headline said that he sees that the ingredients for a blow-off top are in place. So a massive rally is likely going to happen now, and then we're going to top it off for the bull market. And he says that it's very current market conditions are very similar to that of the late 1990s. So if you don't know, then there was a dot-com bubble, which throughout the late 90s it rallied very heavily, right? Before there was a blow-off top, before the markets topped and everything went back down to earth over the next couple of years. And this is where I think many investors, right, who were prudent, diligent, and very unemotional in their approach, managed to buy those high growth companies at very, very attractive valuations. So if you think about it, you could have bought, let's say, I wouldn't say Nvidia. I think Amazon's the prime example for this, right? Amazon stock price back in the early late 2000s and early 2000s, sorry, at around under $1, and today it's trading at around $200+. So this is just one example, right? So Amazon back then, I think it was still loss making, right? So it may not be the easiest company to invest in, but what followed suit was a period where such opportunity existed for even for a couple of years actually. So if you look at Amazon stock price, it traded pretty low for a couple of years before it started to rebound. So what rebound, but ready to take off again. So what he says that he thinks is gonna happen is that it's gonna be a blow off top rally before we see maybe a bear market that could last quite a long time, right? So let's just think. So this got me thinking, like, what are the ingredients that he mentioned now that he says are part of this that could lead to this blow off top rally? So in my opinion, there is 3 ingredients right now that he could potentially see. So number 1 is AI's exponential improvements, right? So regardless of what people say, there is still a lot of money flowing into AI investments. So for example, just recently there is like a OpenAI and AMD chip deal for billions of dollars, right? There's also ownership stake involved and stock related price performance KPI, which is insane, right? So as AMD's business grows, OpenAI has more incentive to sort of like continue doing business with them, and then eventually it will unlock some form of ownership opportunity for OpenAI to invest directly to AMD. And then this is just spirals, right? So it sort of builds like a upward kind of cyclical, like an upward spiral of stock prices, right? So as both companies help each other improve their underlying business, as they gain more sales, it makes more sense for them to invest in each other, and then this will directly pump up their stock price further. So this is just one example, right? You're also seeing like other companies like Nvidia already investing into XAI, for example. So we're gonna see a lot of such deals happening, and it's gonna just pump more liquidity to each other, and the whole bubble, the whole AI bubble will just continue to inflate bigger and bigger and bigger, right? So this is I think a very good example of a blow off top ingredient. But that's it, right? If you look closer into this chart, right, the latest GPT-5 announcements and improvements, right, in performance are already very, very close to human performance. So I wouldn't say that this bubble is like completely unwarranted. Like maybe if you compare back to the .com bubble, right, there were just a lot of companies with the whole .com tag in their names, right, and they can just get listed, and their underlying fundamentals are not that great. But I think for the currently listed publicly listed AI companies, they are doing a lot more better in terms of actually improving work productivity and lives in general of everyone. Just make things easier, faster, and a lot more accessible. So companies can also leverage AI to save on human-related costs. So this makes sense when they continue investing into AI, right? Because your AI, your machines are less error-prone than humans. They are not emotional. So it makes sense for them to continue investing in them as they improve and they lean down their workforce and make things just more efficient and cheaper to operate, right? So I think the investments in AI companies will continue in AI infrastructure. There's gonna be like a game of where uh, such companies just invest in each other after raising more money from even AI related companies like Nvidia, right, who's also now gonna invest in a lot of AI related names. So this bubble is just gonna keep getting inflating bigger and bigger as these valuations get shot higher. People don't want to miss out on the party, right? So there's one ingredient for a good blow off top. Number two, which is your continued rate cuts, right? So as I shared previously in the weekly update video, we're seeing more or less 3 rate cuts indicated for towards the end of the year. 2 more rate cuts towards the end of the year. So obviously it's going to lead to more liquidity flowing in the market. More money is going to flow from your risk-off assets, your risk-on assets like stocks, Bitcoin, and even gold, which you've seen recently just shot past the $4,000 price mark level. So there's going to be more liquidity flowing to your risk-on assets, including stocks. So it will help to fuel the whole blow-off top narrative that Paul Tudor is talking about, right? And seeing here, like what I showed in my previous videos, you should invest in where environment is most liquid, and I think we are approaching that now, right? We're seeing interest rates being cut and a lot more government related expenditures is getting passed now. So we're probably gonna see the markets move into this space, and it also helps that the president is constantly glazing himself in the stock market, saying the stock market is doing very well, stock market prices are high. So I think we are in an environment where we are seeing a lot of risk on appetite supported by your liquidity. So probably this contributes greatly to just a blow off top kind of scenario, right? Lastly, as part of the explanation for part 2, right? So besides the interest rate cuts, we're seeing a lot more spending and money printing, right? So we look at the M2 money supply. It's a lagging chart, but obviously the trend is going back up, right? We're gonna just see this keep going up. And in the short term, at least in the near medium term, you don't really see the Fed looking to hike interest rates again. So probably you're gonna see your M2 money supply gonna continuously go up, right? As long as inflation is contained to some sense, which as of now is pointing towards yes, inflation is being contained nicely. So we're gonna see M2 money supply continue printing, and as there's more money supply, it needs to flow somewhere, and the stock market is a pretty good destination right now for money to flow into, right? And also we're seeing the deficit of this year starting to spiral upwards. Already past the spendings of the past 2 years, right, at this current period of time. So the deficit is widening. There's going to be a lot more spending by the government on your projects, things like that, funding various initiatives. So this makes sense for the stock market to go up because there is just a lot more money circulating in the economy, right? So what are my thoughts on his what he's gonna do, right? So to me, because he is a trader, right? So Paul Tudor Jones is a very well-renowned trader. He's someone who can just like with a snap of his fingers switch his entire narrative, right? So he is probably going to trade the momentum that's happening right now, and it's being aligned with the current narrative, right? So there's no point of him fighting the trend because you don't know where the exuberance may end. High can go higher, right? So in each case, it makes sense for him to average up when the momentum is there. What for average down on if, for example, if you're shorting the markets right now, because the valuation is high, you don't know how high it can go, and your drawdown is just going to be higher and higher. And if in case you don't know, if you're shorting the market, your losses is actually unlimited. But if you're longing the market, the worst you can go is the stock goes to zero, right? But short is basically the stock can go infinite and you're down, right? And to me, he's saying he's seeing a market blow off top. So what are the alternatives? So gold and Bitcoin, which is also he also owns. And I'm pretty bullish on crypto right now because just what's happening with money supply and the potential and everything just aligning to gold and Bitcoin's narrative, which is lowering interest rates, potentially, I say potentially, but inflation is starting to tick down now. So that's also one. If inflation is sticky for some reason, it further boosts the case for Bitcoin and gold. And lastly, there's just a lot of money supply out there. It was just spiral over to this kind of assets as well, especially since gold is kind of a crowded trade right now, and Bitcoin is seen as a proxy to gold, digital gold, right? And number two, if you look at the price movements back in the 1990s, right, this is a blow-off stock I was talking about. So it just like the market just shot up crazily before just collapse out, just collapse down before making a slow gradual recovery. So I think the only thing that could cause this right now, logically, is where liquidity and fundamentals disconnect widely, right? Which I think we're not really seeing for now, because the Magnificent Seven stocks are actually still growing very strongly, right? Their valuations are high, but not insane, right? So there could be room for it to go higher. So high can go higher, and the only disconnect will happen is when there's just too much liquidity, and when this liquidity is sucked away, for example, because the Fed will have to pause interest rates, or they have to start hiking to fight off inflation or things like that, then this will probably cause the things to come back down to earth and for the gap to close, right, between fundamentals and liquidity. So, but that said, there is no signs of this happening for now, and until then, I think we should continue to lean long, but just be cautious as the valuations go higher. So this is what I've been preaching for the past few weeks, right? So my take overall, he's a trader. His perspective and time frame changes very quickly, and he's well equipped to do so. So he sees all the data firsthand. He has a team of analysts running on the numbers for him, and he's just way more experienced, has seen a lot more market cycles than you have. So you probably wouldn't be able to trade the market as well as him and as fast as he can, right? So, and also one example is his take in May. So back when the tariffs were first announced by Trump, right, he says markets are probably seeing new lows, but now he sees new high. So this is how fast it changes perspective. And unless you're someone who is as unemotional as him, you're not committed and love your stocks where you'll be averaged down crazily when the tide turns, right? You probably shouldn't try to time the market and trade like him. So, but for me, how does it all relate back to me and my strategy? So, as I mentioned before, I'm trying to time the market as a mix between a long-term trader that takes into account technicals into entries. But can I go 180 degree like him? Probably not. So I'm just going to look at timing and the entry, and then we'll manage my positions for the long term. Going forward. So I'm still trying to time my entries in the stocks that I'm keeping out a lookout for the longer term. Some of the names include like your Oscar, Zeta, maybe even Exxon, and some of your Magnificent Seven stocks that I think will form a base of my portfolio. But for now, I'm just not seeing opportunities, which is why I haven't been buying. That's it. If you think like I do have a separate portfolio where I diligently DCA into the markets, right? But for this, I'm trying to this particular portfolio that I always show weekly, right? I am still trying to time the market to make a huge return. So just waiting for the opportunity to do so. And for me, right, I think what's more important is picking the right investment vehicle to ride the long-term trend into. So these are the four most important elements that I look out for. Just very quickly running through them, which is management alignment, right? So we're seeing if management's aligned with shareholders in growing the company, whether that is founder-led, whether the management has still a significant ownership stake in the company, right? B, obvious strong growth, right? In terms of the top line, gross margins is strong. It's not growth at all cost model, right? You're not seeing that the company constantly raising debt or issuing shares to fund whatever whatever strategy you're doing. There is signs of profitability. Otherwise, if it's already not profitable, and you are seeing strong cash flow, especially operating cash flow, right? So these are some of the signs that I look out for. Number C, competitive modes. So I think this we have to dive deeper into the company's specific products and services and the sector trends, right? And market share of the company. So if you're eating up more share in the market, that's obviously a good thing. There's obviously a moat there. So some of these competitive modes could come from your patents, your licenses, your capital expenditure needed to build up the infrastructure to fund the business, your pricing power enabled by all this infrastructure, your uniqueness of the technology, your culture and team and manpower can even be in competitive mode. But I think this is most strongly indicated through the gross margins of a product, of a company, right? So if you look, for example, Palantir, right? The company has insane gross margins. So let's go back to the legacy view, shown very clearly. Gross margins over 80%. So I think any companies with gross margins at above 80% level, they have very strong competitive modes because they are able to price that highly, right? Meaning there's no price war, there's nobody else that could snatch the iron rice bowl away from them. D, so limited downside risk. So again, this is also specific to the sector and the company we're going to be looking at. But many of the cases is whether there's competition coming up, whether you see which is strongly indicated by the financials. So you see weakening growth, even declining growth, your margins getting eroded, things like that, right? But I think all of this, you have to do more research into the sector itself to understand the trends that are happening there and whether this company is exposed, right? Especially by rule breakers and technology disruptors, right? Lastly, what I would do is to use the macro and liquidity flows to guide my long-term entries because I'm not a trader. So once I see like liquidity getting sucked up quite badly, I think this liquidity being sucked up very badly is I think once in a couple of years kind of thing scenario, right? So it's impossible for me to not invest in the company until then. But in the short term, if I witness any weakness, right, in valuations, maybe due to like maybe another tariff scare, another war scare, I think it will be a good opportunity for me to enter into a longer term positions because liquidity may not get affected then, right? It's just your valuations which could recover a lot more easily compared to your liquidity levels, right? So what I would do in a nutshell, try to use a technical approach to enter into my long-term positions, which are guided by these 4 principles, right? And then the entries wise, not just technicals, but the heavier buys, I will use macro and liquidity flow to guide my larger terms entry. So that's all for today. Thank you.